Hi everyone, this is Sean, and this week I'll be taking you through the recent criminal charges against Bill Wong and his involvement in the spectacular collapse of Archegos Capital. Bill is an American investor who rose to prominence when he worked for Julian Robertson's Tiger Management. Now, in their own right, Julian and Tiger Management are worthy of a topic for another class. However, to keep it brief, he was a famous investor and hedge fund during the 80s and early 2000s. Analysts who got their start in Tiger Management would later be known as Tiger Cubs. After Tiger Management, Bill opens up his own hedge fund, Tiger Asia Partners. After a bad time during the '08 recession, they later closed after Bill pled guilty with the SEC on insider trading charges. I think we can see where the story is going. Later, in 2012, Bill opens up Archegos Capital as a family office to manage his own personal fortune. As a brief primer, a family office is a privately held wealth management company focused on managing the wealth of ultra-high net worth individuals. The difference between an office and a hedge fund is that the family office is focused on its primary client rather than its group of investors. In the case of Archegos, it is Bill's and his family's personal money that they are investing. Archegos operated with a simple strategy: pick a few winners and invest in them with a lot of leverage. They did this using total return swaps. A total return swap is a type of derivative where one party agrees to exchange the returns of a portfolio of assets in exchange for a spread plus LIBOR. So a quick example, if I were to buy a total return swap for $1 million in SPY, we'll call the spread 5% and we'll say it's a year-long contract. It's a great year for SPY, unlike now. Let's say SPY ends the year at 15%. So I would be owed the 15% of that million, $150,000, and then I would have to pay out 5%, which would be $50,000. Now, the main advantage of the swap is I can create incredible leverage with only a small payment to cover my margin. However, my risk is that if there's a downturn, I could be margin called to, again, bring my account back up to that maintenance margin level. Now, in the case of Archegos, they were able to use swaps to maintain leverage ratios of 400, even 1,000%. On top of that, and this will come into play soon, Archegos avoided reporting thresholds requirements under Section 13D, because technically Archegos owns the derivative, not the actual underlying asset. Joke's on you, Alphabet Agency. So over the course of a year using these swaps, we can see how Archegos' exposure to its top 10 holdings increased. Using a couple examples, between Viacom, their $1.2 billion position in July of 2020 grew in less than a year to $28.6 billion. In their Discovery Class C shares, their $25 million in holdings grew to $6 billion of exposure by March of 2021. And despite recommendations from Archegos' own research department, clearly don't have any astute economists on board, the majority of their holdings were in these top 10 positions. And as a quick caveat, this picture is courtesy of the SEC indictment, which is sourced on the back, and I highly encourage you all to read it. So what does this translate for the market? Well, as we can see, Archegos' leverage was so great that they effectively owned 30 to 70% of the outstanding shares for their top 10 holdings. By having control over a significant portion of the outstanding shares, Archegos was effectively able to bid up its own portfolio over the course of a year, growing into one of the largest family offices on the street. As you can imagine, owning all these stocks in secrecy will have a strong effect on returns. From 2020 to 2021, Archegos' shares in Viacom, for example, saw exponential returns, especially compared to the market. The returns were so abnormal that even Viacom executives couldn't comment on the price action. What was historically a $50 stock was cresting near $100. Now, it all came down in late March. On March 24th, Viacom, wanting to mimic the success of Elon and meme stock companies alike decided to raise cash through a new share offering. It was estimated $3 billion, priced at $85 a share. In addition, Sino-American relationships were not the greatest. The US issued a new law requiring all Chinese listed stocks to be audited or get delisted. And in addition, China was starting to crack down on monopolistic tech practices. There was growing fraud in a lot of tech space, tech education space, and even Jack Ma disappeared for a couple months. What all this translated to was tremendous downward pressure on Archegos' holdings. Now, recall from earlier lessons, when your margin at a broker falls below the maintenance margin required, you get margin called. This downward pressure made Archegos get margin called from all of its brokers. Now, Archegos was caught up in a scheme of deceiving many prime brokers, and when some caught wind of what was unraveling, they began to unwind their position, knowing Archegos wouldn't be able to make the margin calls. And what happened was an exponential drop in price for these stocks. In the aftermath, the unwinding was to a tune of $20 billion gone in 2 days. In the aftermath, a couple desks were able to escape relatively unscathed. Goldman and, can't believe I'm saying this, Deutsche Bank and Wells Fargo escaped with relatively minimal loss. Credit Suisse and Nomura, on the other hand, suffered extensive loss. With Credit Suisse being so bad, they decided to exit the prime brokerage business by closing their desk and later issuing an extensive 172-page report to their board detailing how they will remediate these issues in risk management. And now in the aftermath of all this, we're still left with a couple questions. Ultimately, what will Bill's fate be? Obviously, the SEC is charging him, but is this a clear-cut case of manipulation or a creative use of derivatives? In addition to that, how innocent were the banks in all this? For most banks, these brokerage units are huge profit centers. They're there to facilitate trades and also hedge their risk, but in this case, they didn't really hedge their risk. A lot of these banks kind of allowed Archegos to continue this charade for the better part of a year, and some were lucky to escape the burning house, while others, like Credit Suisse, were not. And, we have to ask ourselves our question. Archegos was using many banks. By the sheer size of these positions and trades and market activity, how could they not have known? Anyway, here are my sources. I hope you all enjoyed my presentation. I look forward to reading the discussion, and I encourage everyone to go over the SEC indictment and even peruse the Credit Suisse write-up. It's pretty interesting. Hope you all have a great week. Thank you.